Hi, I'm Calvin Rose, and welcome to Invest Smarter. Before we get started, I sat down here to make this video, and I just can't get Ukraine out of my mind. If any of you watching out there can donate money to many of the organizations that are trying to help people in so many ways, please do it. I will put some links in the pinned comments below to organizations that will let you donate in whatever way that makes sense for you. So please consider doing that. In the first two parts of this three-part series, we covered why it's important to save and invest and the impact it can have on your life, not just today, but decades from now. And we also covered the basics of investments, risk versus safety, and how to create a very simple portfolio out of two different investment types, risk and safety. In this video, we're going to get into a little bit more of the details about how to create a very simple portfolio that will work for you. They don't need to be complicated. In fact, we'll show you that and why overcomplicated portfolios don't work. So let's get into the video. In order for you to create your own portfolios, we're going to have to talk a little bit about what you're going to invest in. And you probably heard about stocks and bonds and mutual funds and ETFs and all of those sorts of things. But we're going to focus in on exchange traded funds. Exchange traded funds are a basket of individual stocks or bonds or commodities that you can then go and buy just very easily. You just open up an account and buy some various ETFs, and now you have exposure to risk and safety assets. So it's a pretty straightforward process. Basically, what Investopedia says is an exchange traded fund is a basket of securities that trades on an exchange, just like stock does. So the New York Stock Exchange or the NASDAQ exchange. So you can buy and sell ETFs during the day when the markets are open. Unlike a mutual fund where you can only buy them at the close of the day. And look, for practical purposes, just stay away from mutual funds if you can. They're more expensive, they're harder to trade, and blah, blah, blah. Just stay away from them. So the other thing is, because they trade all day, their share price fluctuates with the underlying basket of stocks. So the price will change during the day. And then, as I already mentioned, ETFs can contain all types of investments, including stocks, commodities, bonds, etc. And then another advantage of ETFs, as I already kind of hinted over mutual funds, is that they're lower cost. They have lower fees, and they typically don't have any trading commissions when you trade them. In order to invest your hard-earned money, you're going to have to open up a brokerage account. There are 4 of them that I would recommend. Basically, I've had experience with 3 of them. I have not with the 4th. The platforms that I would recommend are Charles Schwab, TD Ameritrade, Fidelity Investments, or Robinhood. Now, Robinhood's the one I have not used. I've used all of the other 3, and they're fantastic. You can set up an account, you can move your money in and out of there very easily from your bank account, and you can trade very easily into the portfolios that we'll talk about a little bit later. Let's talk about simple and effective portfolio construction. Look, you're going to hear a lot of what I call common wisdom out there. It's common, but it's not very wise. A lot of people are going to tell you, oh, you got to diversify, you got to diversify. Yeah, you do, but not the way that most people do it. And I'm going to show you exactly what I'm talking about. And it's really important that you understand this so you can manage your own portfolio effectively and not listen to all the chatter and noise you're going to hear over your lifetime about this. So let's take a look here. And if you watched the part 2 of this series, you're already very familiar with this graph. It's a very simple way to look at investments. So if you watched part 2 of this series, or if you didn't, this graph is very simple. Anything in the upper left portion up here is good. And you can see that's the nice blue area, very pleasant. And anything that falls over here lower and to the right is bad. And you can see that's kind of reddish in color. So now that we've established that, what are we looking at here? Well, we're looking at a typically diversified portfolio. If you look at websites that explain how to diversify your portfolio, or organizations that do this, you're going to see a portfolio just like this. It has a little of everything in it, so it's diversified. So you can see it has aggregate bond index, which is a very diverse bond index. It has high yield bonds, which are riskier bonds, so you're trying to get a little more return there, which, as I mentioned in previous videos, is not a good idea. So on the risk side of things, it has large cap, small cap, mid cap, foreign large cap, emerging markets, real estate, and commodities. So basically everything, including the kitchen sink here in this portfolio. So why do I say this is not a good way to invest? For surely I'm protected here, and this has to perform better. I've got a little bit of everything in there. Well, it doesn't quite work that way, and let me show you why. So this is what I'm showing you here is basically what these organizations call a conservative portfolio. Now, by my standards, a portfolio that could lose almost 27% of its value is not conservative, but let's go with their definition. So this is a conservative portfolio. So what if we take some more risk here? Well, as a logical person, if I'm going to take more risk, I would really like to see some more return. Okay, so let's see what happens. Let's take some more risk. Let's go to a moderate portfolio. And what did we see here when I increased the risk? So now there's more. You see all these bubbles got bigger on the risk side, and they got smaller on the, quote, safety side. But what happened? What happened to the total portfolio here? Let's go back and take a look. So here, in the conservative case, the portfolio had a 5.16% return, annual rate of return. That's kind of the average return over the 15-year period. And it had a 26.7% maximum loss. So when we go to moderate, what happens to the return and what happens to the loss? Well, the return, went up a little tiny bit from 5.16% to 5.41%. But now our loss went up a lot. It went from minus 26+% to minus 37%. So you got a teeny tiny little bit of extra return for 11 or 12 or 13% additional loss. That's really not a good trade-off. Oh, well, maybe if we take some more risk, we'll get better returns. Well, let's try that. Let's go to their aggressive portfolio. Wow. Okay, so now we got an additional 0.03% return for a whole lot more maximum loss. So this is not a good trade-off. Look, take my word for it. Don't listen to the common wisdom. Don't overcomplicate your portfolios. Now let's talk about how you can create a simple portfolio that will serve you really well over the long term. Okay, so let's have a little bit of fun here. Let's talk about how you can create 3 different portfolios that will match your risk tolerance and give you very good performance over the long term. You remember those complicated portfolios we looked at just before this. Well, let's look at a conservative portfolio that only uses 3 components. So it's not complicated, but it will give you much better performance than that very complicated portfolio that I showed you earlier. So what if we take our portfolio and we put 20% of it in the S&P 500? Now, how do you do that? Well, in your brokerage account, you take 20% of your money and you put it in the ETF SPY, SPY, which invests in the S&P 500. So now you have a diversified equity portfolio as part of your portfolio. And then we're going to take the safety portion, and since there's 80% left, let's put half of it in shorter duration government treasuries. If you watched the second part of this series, we talked about when you give loans to the government, the shorter the loan, the less risky it is. So 90-day T-bills, treasury bills, are risk-free, basically. They're considered risk-free. As you go out further in time to 2, 5, 10 years, you're taking more risk. And then when you go to 20 or 30 years, you're taking a lot more risk. in those loans you're giving to the government. So we're going to put 40% of our portfolio in what are called short-term treasuries, 1 to 3 years, and let's put the other 40% in IEF, the ETF IEF, which invests in 7 to 10 year government treasuries. So you can see this portfolio has the same performance just about as that conservative complicated portfolio I showed you previously, but the maximum loss is way better. I don't know if you remember, the maximum loss of that previous conservative portfolio was, I think, minus 26.7%, almost 27%. This one is less than 8% of a maximum loss. So much, much, much better performance here, and a much simpler portfolio that you can do yourself. Now, I'm going to show you some other things you can do. You can say, well, but S&P is full of old stodgy companies, big cap. I'm more forward looking. I would like to invest in more innovative stocks. So what if instead of the S&P 500, we took that 20% and we put it in the NASDAQ 100, which is the ETF QQQ. Now you can see that QQQ has a lot more return than the S&P 500 did down here. And as a result, your portfolio has better return, slightly more loss, but definitely better return. So you could do that. Or you could say, well, I'm a fan of the Dow Jones Industrial Average, so I'm going to put 20% there instead. And you can see that gives the worst performance. But maybe you like the stability of the Dow Jones Industrial Average, so mix it up. Take 10% and put it in the Dow Jones Industrial Average, and 10% and put it in the NASDAQ 100, and you get something that's a little better than the S&P 500 alone. Not as good as the NASDAQ 100, but you've got a portfolio here that's got reasonable performance. The thing is, this isn't rocket science. It's not hard to do. You don't have to create a complicated portfolio. So this is a conservative portfolio, and I agree that this is conservative. It's got a reasonable return and not a horrible loss characteristic. So now, let's say you want to take some more risk, and you want to make your portfolio a little more of what we might call moderate. So now let's put 40% in the S&P 500, and let's put 60% in IEF, the 7 to 10 year government treasuries. Now you notice I didn't put any SHY in here. And why did I do that? Well, as you take more risk on the equity side, on the risk side of things, you also need to take a little more risk on the safety side of things. They kind of tend to balance out better that way. I mean, let's take a look at it. Let's get rid of the IEF and let's put in 60% SHY. So let's see, what do we have here? We've got a 5.7% return and a 21.86% maximum loss. Well, what happens if we take that 60% and put it in IEF? Wow, well, you're getting more return and you're getting better loss characteristics. You see why you need to do that. All right, so now let's go back to the other examples. So let's say you want to do forward-looking companies. You put 40% in the NASDAQ 100. You're getting a much higher return here, a reasonable loss characteristic. And again, you can say, well, I want to split this between the Dow and the NASDAQ 100, and this is what you get. Okay, so again, simple portfolio, easy to do. You can do this yourself. You don't have to make it complicated. Finally, let's take a look at what I would call an aggressive portfolio. I would not go any more aggressive than this, and I'll show you why. But let's make an aggressive portfolio here. So now we're going to put 60% in the S&P 500 in SPY, in the ETF SPY. And now, because we're taking more risk in our portfolio overall, we're going to put the other 40% in TLT, which are longer-term treasury bonds. And now you can see that you've got a 10% return here. Now, I remember seeing that level of return in the moderate portfolio, but I believe we were using the NASDAQ 100, not the S&P 500. But you can see as you take more risk, your maximum loss also gets worse here. But this maximum loss, by the way, isn't much worse than that very complicated, over-diversified, conservative portfolio that we showed earlier. You don't need to be complicated to get better results. So now let's take this 60% as we did before, and let's put it in the NASDAQ 100. Wow, okay, so now I've got some pretty juicy returns here, but I've still got a pretty hefty maximum loss. So if you want to moderate that somewhat, let's put 30% in the NASDAQ 100 and 30% in the Dow Jones Industrial Average. And you get a little bit better loss characteristic, and you give up a fair amount of return. But the point is, you can make these portfolios with 2 or 3 components very simply, maybe 4 maximum in the conservative case, and you get better results over the long term without the expense of having somebody who doesn't know what they're doing try to do this for you. I almost forgot to show you this. So remember earlier I said you really shouldn't take more risk than this, having 60% of your portfolio in risk assets. Well, let's look at what happens when you do that. Let's go back to a simple case just to keep it simple. Here, I'm going to put 60% in the S&P 500. So here we've got a portfolio. You're getting, by the way, just about the same return as the S&P 500. S&P 500 over this period had a 10.41% return, and your portfolio is getting 10%. So you're getting almost all of the return with just a little bit more than half of the maximum loss here. Now, if we try to be more aggressive, and this is what the common wisdom would tell you to do if you're young, is to say put 80% of your money in risk and only 20% in safety. What happens here? Well, okay, I'm getting the return of the S&P 500, all right. I'm getting that extra little, 0.4% or whatever return that I didn't get when I was only 60% exposed here. But look what happened to the maximum loss. It went up a huge amount. So look, don't go there. Don't listen to people that tell you because you're young you have to be all in equities, or you've got to take 80% of your money and put it in risk. Don't listen to them. You're not going to get, over the long term, you're not going to get good performance that way. And worse yet, you're going to get scared when you watch 40% of your portfolio go away. And guess what? You might sell it and lock in your losses, and then you'll really get hurt. So just don't do that to start with. So keep it simple. Keep a fair amount of safety around. My suggestion would actually be 50-50, which I talked about in part 2 of the video. I think that's probably the sweet spot here. You're getting most of the return of the S&P 500 with less than half of the loss. As one of my favorite YouTubers would say, if you're still watching, you are awesome. Really appreciate it, and thank you for taking the time to watch today. That's all for now.